Good morning to you all. Welcome back to my fifth video. I will continue with call option example number 4. The example says Mr. Bharat sells a 3-month call option at a premium of rupees 10. The exercise price is rupees 210. Share price of Reliance is selling for rupees 200. What is the payoff of Mr. Bharat if the spot price or the current market price at the end is rupees 190 or 200 or 210 or 220 or 230? So how to go for the solution? As I said, the first thing we need to check in a transaction is the nature of contract. Here it is a short call or a sell call option. So this is the crux of the question, the same information as we solved example number 3, current market price in the beginning. So all the information is just the same, and we have been provided with 5 situations. What will happen to the payoff if the spot price moves to 190 or 200, 210 or 220 or 230? So what is the point that we have to remember here is a call option will be exercised only when the current market price is greater than the exercise, whether it is from the point of view of the buyer or from the point of view of the seller. The option will be exercised, a call option will be exercised only when the current market price is greater than the exercise price. And the second point that we have to remember here is the premium part. Is the premium an income or an expense? Definitely it is from the seller's point of view we are seeing. So for the seller, the premium will be an income, and we'll move further to calculate the payoff. So now we have to go back to the grid and we have to see where this sell call falls. So if I check the grid, the sell call or the short call comes in this particular quadrant. So here the premium is an income, the strike price is also an income, whereas the current market price at the end or the spot price becomes an expense. So all the explanation why it is an income and why it is it's an expense I have given in the previous video itself. So based upon this, I'll take the premium and strike as a income. So yes, the premium and the strike are the income, whereas the current market price or the spot price becomes the expense. So as I said, we can fill the current market price. So different situation the question says. So if the current market price is 190, 200, 210, 220 and 230. So these are the 5 situations. So we can fill it with no difficulty. The next thing that we can fill is the premium part. So premium is an income, so that also we can fill for all the 5 situations. What we cannot fill is the exercise price, because that depends upon the situation whether the current market price is greater than the exercise price or current market price is less than the exercise price. As I said, the option will be exercised, a call option will be exercised only when the current market price is greater than the exercise price. So now we have to check for each situation whether the current market price is greater or not. So coming back to situation number 1, is the current market price 190 greater than the exercise price of 210? No. So it will not be exercised. So that is what I've written, not exercised. There's a blank over here. Second one, is the current market price 200 greater than the exercise price of 210? No. So again the option will not be exercised. So it is a blank over here and I've written as not exercised. Third one, is the current market price 210 greater than the exercise price of 210? No. So the option again will not be exercised. Coming to the fourth situation, is the current market price 220 greater than the exercise price of 210? Yes. So whenever an option or a contract is exercised, we have to fill that particular space. So here whatever exercise price is given over here, I have filled it here. Now the fifth situation again, is the current market price 230 greater than the exercise price of 210? Yes. So yes, it will be exercised and I can fill 210 over here. Wherever it is not exercised, I have put a blank, and wherever it is exercised, I have written the exercise price. Now, the next step that we have to take care of is wherever it is not exercised, so there are three situations where the contract is not exercised. So I will strike this information. The information of current market price, I'll be striking it off. So the information that I will be considering is only the premium part. I have striked off this 190, this 200 and 210 because in these three situations the option was not exercised. Now the remaining information in this particular column is only 10. So this 10 being an income comes under the payoff. So this is an income. So that's what I've just written exactly. I've written over here. In the second situation also, only this premium of 10 rupees is an income. So I have written over here. The third one also, the 10 I have taken directly here. In the fourth situation, the total income is 210 plus another 10 of premium, making a total of 220. And here it's a minus 220. So plus 220 minus 220, it is 0. The last situation, there is a 210 over here, which is the exercise price, and a 10 rupees premium, making a total of positive 220. A positive 220 and a negative 230 gives a minus 10. So this minus 10 I have written over here. So based on this information, that is a positive 10, 10, a positive 10 again, a 0 and a minus 10. Based on this information, when we draw the payoff in a chart form, it will be coming like this. So there is a positive value followed by a 0 and followed by a negative 10. Here it is this particular zone is unlimited loss zone, whereas this is a limited profit zone. It's not a loss zone, it's a limited profit zone, whereas this particular, I'll strike it off properly, this is a limited profit zone because the profit is restricted to 10 rupees, 10, 10 and 10. So limited profit zone, there's a break-even price over here followed by unlimited loss zone over here. Hope this short call or sell call is also very clear to you. So on that happy note, I finish my 5th video. Let's all meet in the next video. Till such time, bye, take care, see you.